One question is suddenly driving global markets. How can a war that pushed oil toward $119 a barrel overnight end with prices crashing hours later? On the same day, financial markets erased losses worth hundreds of billions of dollars, while energy traders abruptly reversed their bets. This video unpacks the strategic signals, the military calculations, and the fragile oil system behind that sudden shift, revealing why a single geopolitical message can move the global economy within minutes without resolving the deeper crisis forming underneath. If the conflict around Iran expands, the consequences extend far beyond the battlefield. Roughly 1/5 of the world's oil supply moves through the Strait of Hormuz, a narrow maritime corridor linking the Persian Gulf to global shipping lanes. Any sustained disruption there immediately reshapes inflation, trade, and political stability across Asia, Europe, and North America. When signals from Washington suggested military objectives were nearing completion, traders recalculated risk, triggering a dramatic market reversal that briefly calmed investors while leaving the structural vulnerabilities of energy supply exposed. The confrontation sits inside a longer history of tension between the United States and Iran, shaped by sanctions, regional proxy rivalries, and decades of strategic mistrust. Since the late 20th century, control over Gulf energy routes has remained central to global power competition. The waterway at Hormuz carries more than 20 million barrels of oil each day, alongside major liquefied natural gas shipments from Qatar. When military operations began under the codename Operation Epic Fury, energy markets immediately priced in the possibility that this corridor could close. A scenario capable of removing millions of barrels from daily global supply within days and sending shockwaves through manufacturing, transport, and food systems worldwide almost instantly after the first reports of disruption appeared. By Monday morning, the panic was visible in prices. United States crude briefly surged 32% overnight to around $119 per barrel, while the global Brent benchmark climbed close to $90. Equity markets reacted just as sharply. The S&P 500 dropped about 1.5%, the Nasdaq composite slid more than 1%, and the Dow Jones Industrial Average at one stage lost roughly 880 points. Yet by afternoon, a message from the American president indicating that the campaign was approaching completion changed expectations, driving oil down toward $86 and pushing major stock indices back into positive territory before the closing bell on Wall Street that evening as traders unwound emergency hedges. Across international markets, the volatility spread quickly. Japan's Nikkei 225 index recorded its worst session since a tariff shock the previous year, falling about 5.2% and entering correction territory. South Korea's Kospi slid roughly 6%, forcing a temporary 20-minute trading halt during intense selling. European benchmarks also weakened, with the Stoxx 600 declining about 0.6%, while national indices in Germany, France, Italy, and Spain each lost around 1%. At the same time, bond markets reversed earlier losses, sending the yield on the 10-year United States Treasury near 4.10% and the 30-year yield around 4.71%, reflecting investors rotating back toward government debt as immediate panic eased, but uncertainty remained deeply embedded in pricing. Energy fundamentals explain why the reaction was so violent. Even after the pullback, American crude prices remain more than 50% higher than at the start of the year, with gains exceeding 30% in only 5 days. Average gasoline costs in the United States have climbed above $3.49 per gallon, roughly 50 cents higher since the conflict began. Natural gas futures in New York dropped about 4% after earlier gains, while heating oil, often used as a proxy for jet fuel, swung from a 23% surge to an 8% decline within hours, illustrating how quickly supply expectations rather than physical shortages can reshape valuations across the entire petroleum chain, from drilling fields to airline balance sheets. Meanwhile, the physical supply situation remains fragile. Several Gulf producers, including Kuwait, the United Arab Emirates, and reportedly Saudi Arabia, have already reduced output as shipping risks intensify near Iranian waters. Analysts estimate that around 2 million barrels per day of production has been curtailed, with projections suggesting that more than 4 million barrels could be forced offline if export bottlenecks persist through the week. Tankers approaching the Strait of Hormuz have reported threatening radio messages, while maritime monitoring agencies note several incidents targeting vessels in nearby waters. Storage facilities across the region are also nearing capacity, meaning producers may soon need to shut wells temporarily, even without direct physical damage to infrastructure or pipelines carrying crude toward export terminals. Governments are therefore weighing intervention. Finance ministers from major industrial economies recently held an emergency video conference to discuss releasing strategic petroleum reserves, a tool previously used during supply crises. For now, they concluded, conditions had not yet reached the threshold requiring coordinated stockpile deployment, though officials signaled readiness to act if disruptions intensify. One scenario policymakers quietly examine imagines the strait reopening quickly after limited military objectives are achieved, allowing tankers to resume normal traffic and pushing oil back toward pre-crisis ranges. Another scenario assumes prolonged disruption, where additional exporters such as the United Arab Emirates or Qatar suspend shipments, tightening global supply enough to prolong inflationary pressure across major importing economies, including India, whose energy security planning critics argue has lacked diversification and storage expansion in recent years. In that context, debates inside India have intensified because the country imports more than 85% of its crude consumption. Critics of Prime Minister Narendra Modi's government argue that slow progress in expanding strategic petroleum reserves, limited diversification of suppliers, and heavy dependence on seaborne Gulf energy leave the economy exposed whenever tensions escalate in the region. Supporters counter that structural constraints and global market dynamics restrict how quickly any government can reduce that vulnerability. What ultimately matters for the wider international system is whether the confrontation stabilizes or evolves into a longer disruption of the Gulf's energy arteries. Markets reacted to one signal of possible closure and another suggesting imminent completion of military objectives, yet the deeper question remains unresolved: how durable global stability really is when a narrow strait and a few political decisions can still redirect trillions in economic expectations.